Well, this week we're reviewing the Mazi Capital Met Equity Fund. Managers there, Patrice Moyal and Molungelo Zilimbola. I hope I got that pronunciation correct. Fund size 946 million rand, almost 1 billion. Inception date August 2010, TR 1.26%. And the objective is the SWIG. So what makes Mazi an interesting fund to look at?
Well, again, this is now the second fund that we're looking at that was kind of one of the top performers in the general equity space over the last 12 months. Now, the issue that we're sitting with here, obviously, is that we don't have a huge amount of track record to actually work with. So we're not going to be able to look at the normal graphs that we look at. There's kind of those rolling 12-month return graphs and under and outperformance relative to benchmark. But one thing that I want to point out over here is this is an August 2010 inception fund and already has close to about 1 billion rand in there, which is absolutely phenomenal for a fund with a short-term track record. Just to show you quickly what that track record looks like, have a look there. There you can see the equity fund. That's in the Mazi equity, the capital equity fund. That's in blue relative to the shareholder weighted index, and you can see there's the massive alpha amount that they've built up there over time. Just to show you quickly what the returns look like. There's 1 year and 2 year returns, and you can see what the fund returns look like relative to the benchmark. And look at those over and under returns. Both of those are obviously over. 2 years over outperformance there of about 7.1%. So all round, I mean, it looks like a fairly decent fund with a very, very strong track record right in the beginning. We can't necessarily attest this to a small fund size because the fund, quite frankly, is close to $1 billion already. You know.
Well, what do you think of the fact that they managed to, in such a short period of time, become one of the top performing funds in 2012?
Well, I think they've done the right things at the right time, in the sense that certainly you'll see that the performance really has taken off in 2012. They did have some outperformance in 2011, but recently that's probably come again from the effect, the sort of 2012 effect, which we call the year of the large caps. And they certainly stuck with some very good performing large cap companies that have outperformed. I see quite a few foreign companies again, but things like Life Healthcare, those are kind of stocks that have just shot the lights out and are now becoming a large cap stock, but they picked up on that one. They do have quite a big retail exposure according to their sector allocation. So let's hope that they can offload some of that, because again, these stats are a bit out of date. Because retail is seemingly looking like it's selling off quite strongly.
Do you think that this trend in the sell-off in retailers and everyone, this is the hot question right now, is going to persist? I mean, because ultimately everyone was saying the foreigners are buying the retailers, they're pushing up our valuations, and do you think that ultimately we are going to see a sustained pullback in retailers? Where's your head with that?
Well, we started seeing some retailers actually report some earnings numbers and just kind of sales numbers up to the end of December, and some of them have actually missed estimates. So that means that, quite frankly, there weren't as many feet through the stores as what they thought there was going to be. And that obviously is putting valuations more under pressure. Now the question is, and this is the big question, is what is the right valuation number as far as retailers are concerned? Because they're coming from valuations that were sitting, some of them, beyond 20 times earnings. So quite frankly, if they pull back to 18 times earnings in 17 and 16, what becomes a fair price for these? I think, the sell-off was pronounced. If you're looking again at correlation between valuation and long-term earnings or long-term returns, you're going to have to wait for these things to pull back to at least to their long-term averages, which kind of runs at about 12, 13 times earnings. And they might even undercorrect on the other side before they come back for more on the other side,
We speak to quite a few foreign investors, and what certainly we are hearing is that what triggered the sell-off in retailers was obviously the sort of disappointing trading updates that they put out, but one of the key catalysts has been the rand. So what's happened in January as a foreign investor is you've not only lost 5-6% in terms of your depreciated rand by holding South African retailers, but the retail stocks have also sold off by 5-6-7%. So you've actually lost 12% in 1 month as a foreign investor, and that has caused them to start taking profit quite strongly. So we are seeing the foreigners now starting to sell, and
I mean, these aren't, the sell-off
buyers.
Sell-off is not companies that are small by any means. Fantastically well-run companies, quality companies, the likes of Shoprite, Woolies, and these companies are not going to go anywhere. Does it make sense to sell from here, though?
Well, fundamentally, they still have a strong argument because the whole reason why foreigners were buying these companies is for the Africa expansion, and these companies are growing more quickly than other companies in emerging markets. So there's good reason to be invested in these, but they have just run too hard, and any weakness in the currency or volatility in the currencies makes foreigners very nervous, and they're just going to pull out and wait for that volatility to quieten down again before they come in. So you could see, another 10-15% downside in the retailers, and then they start rallying again.
On the one side of the equation, you've got this sweet African story on the one side. People saying, look, we're going to get growth when nobody has ever got growth before. And quite frankly, if you want to be part of that story, pay up, and that's 20 times earnings, 20 PE type stocks and beyond that. That's what you pay on the one side of the equation. And then the other side, you look at European retailers. Now, given they're not in fast growing markets, but some of these things are trading at like 6 and 7 PEs. Now, what we've seen is we've just seen a swap around. People have started saying, well, quite frankly, people in Europe need to eat. Quite frankly, they're not going to live on clean air alone. So quite frankly, why don't we look at how we potentially could putting money into those. Those have progressively started actually rising in value, whereas you've seen the sweet growth stories actually starting to kind of coming back to kind of their long-term averages. So you're certainly seeing some of those. Let's just look quickly at the Mazi Capital Equity Fund. I just want to show you what the top 10 holdings look like, and this obviously is at the end of December 2012. We're now running towards the end of January already, and you just want to have a look there quickly. MTN right at the top at 5.9. Old Mutual also had a big weighter there at 5.9. And then it goes down. South African breweries, obviously a fairly decent rand hedge with BHP Billiton at 4.5 and 4.2. And then you run down the list there. Richemont, 3.9. We saw that stock down 7% the other day, and that's predominantly because they missed their earnings beat. And then Anglo American at 3.7. And you can see some of the other ones over there.
So there we go. Some, quality companies, large caps. You talk about the year of the large caps. But the question, what would your advice be to retail investors who see a fund like this? This is new to the market, and of course doesn't have a strong track record. How do you assess future performance and an outlook for them based on such a short time frame?
Look, firstly, I think Patrice and them, it's a valuation shop. So they try and understand valuation, what the opportunity set is, and if they should be participating in buying a specific company. The question one has to ask oneself as an investor is, do you buy into philosophically what they're trying to achieve? A company or a fund with a very short-term track record, the best thing that you could potentially do is pick up the phone, speak to some people, hear how they manage the actual fund, hear what they do with the fund, and then once you can understand some of those fundamentals, well then quite frankly you either align with it or you don't.
And Roland, you agree with that?
I agree with that. I think this fund is correctly positioned at the moment in terms of a lot of large cap exposure, which still is a quality kind of play, and also high cash dividend yield paying companies. They have got a lot of offshore companies that are listed in South Africa, which is again the kind of flavor of the year. I would say in 6 months' time, one would have to revisit that kind of strategy, and I'm sure they will, because you don't want to be exposed to large caps for too long if we are expecting the market to sell off at some point because it's been running so hard.